Welcome everyone, and thank you for joining us at this very important discussion today. Let me invite Ms. Sunita Reddy, our director, to welcome the speakers of the evening and start the session. Sunita, over to you.
Thank you, Vanita. Good evening, everyone. It is a pleasure to be here with you this evening. Let me start by saying you're in both a safe and secure place. Safe because you're in front of your computers, secure because of the company you have. We are in conversation today with Dr. K. Subramaniam, who all of you know is our Chief Economic Advisor. We also have with us Mr. Neelakant Mishra, who is the Chief Analyst and Head of Credit Suisse. Mr. Mishra has been voted by Asia Money as one of the leading authorities on financial markets. So having said that, let me set the backdrop. I think all of us are concerned about how businesses will revive post-COVID. And clearly, we look to the government to see how effective the government schemes will be. We've seen 2.5% of GDP committed by the RBI to easing out some liquidity pressures. But I think all of us wonder, are we looking at only liquidity, or are we looking far more to a fiscal stimulus and finally to some demand generation? Right now, when all of us are concerned about life and livelihood, I think it's at a crucial time that we have this conversation. And with this, let me hand over to Dr. Subramaniam.
I was saying actually good evening to everyone, and hopefully all of you are staying safe. As I was saying, this episode is something that none of us would have encountered during our lifetimes. And so, there is significant uncertainty, what we economists think about as unknown unknowns, not just unknowns, but unknown unknowns. And so, each one of us, including people here and people like Neelakant, and others are actually coming up with estimates, but continually recalibrating because of the uncertainty. What I'm going to do is, try and use a proxy which I think is quite useful for us to estimate, on the economic side and then on the health side as well, what might be the potential impact. So, if we look at the 1918 Spanish flu, the 1918 Spanish flu is a very good proxy, and here's why I'm going to just explain in a minute. I think for the learnings that we can gather from the 1918 Spanish flu, and there's now research that has appeared for the United States, a burgeoning of research on that episode. There are important learnings that we can have for India as well. First, if in any pandemic, as they say that the number R naught, which by now I think everybody would have gotten familiar with this number, which is essentially the number of people that each infected person is likely to infect. That is supposed to be up between 2.2 to 2.4. This is numbers that Larry Brilliant, the epidemiologist who was involved in the movie Contagion, estimates for the COVID pandemic, and he also estimates for the Spanish flu that the R naught was around 2, and therefore it's a very reasonable proxy. Just to give comparison, the normal flu has an R naught of anywhere between 1.2 to 1.5, while the smallpox had, for instance, an R naught of between 3.5 to 4.5. So the Spanish flu is a very useful proxy, just to also see why what stuff that might happen in the United States can be a good proxy for us in terms of the GDP per capita, in terms of the proportion of the GDP per capita of the United States in 1918 and what we have today, in terms of the overall growth rates, the proportion of manufacturing activity, the overall economic activity, service sector activity, proportion of urban population. In all these measures, India is very comparable to what the United States was in 1918. I want to actually show you one particular slide, and before that, talk about, a lot of experts have actually mentioned that there is this trade-off between flattening the curve for the pandemic and the economic impact of that. So flattening the pandemic actually exacerbates the economic impact, which certainly would be true in the short run, and I think as we ourselves are witnessing during the lockdown. But it's also important to keep in mind some of the long run impacts over maybe a year and a half to what would manifest. And there I just want to actually share something with you all. So let me just, so this is a chart, from a very recent research paper for the various counties in the United States. And so what is, on the x-axis, what is plotted is the mortality rate in the particular county, and on the y-axis is the change in employment, from 1914 to 1919. So over a 5-year period. Remember, 1918 was when the pandemic was at its peak, so the change in employment during that period. So 4 years before the episode to 1 year after the episode. What is very clear is that overall, if there was mortality was higher, clearly the employment was lower. So the economic impact was greater when the mortality was higher. But what is quite interesting is when we actually compare between the green dots here and the red dots. The green dots are for those counties where the non-pharmaceutical interventions, which are basically various kinds of lockdowns, for instance, school closures, shopping centers, all those actually, those are the examples. In some sense, this is deja vu, because same thing, newspapers covered in the case of the 1918 Spanish flu. So when the intervention was more intensive, that's what is being captured by these green dots, where the total number of non-pharmaceutical intervention, NPI for the non-pharmaceutical intervention, when it was above the median, those are basically your green dots, and the red dots are when the intervention was less intensive, the number of NPI days was less than the median. And what is quite clear from this chart is that the green dots, on average there, the mortality was lower. At the same time, the increase in employment also was higher. In contrast, the red dots actually, the mortality was greater. Employment increase was also, not as good. Was lower compared to the green dots. So what this suggests is that while clearly in the short run there is this trade-off between the intensity of the measures, of the social distancing measures that are taken, in the long run, there is basically this trade-off, at least in the data, seems to actually, go away. And that is, I think, good news, because we have, in India, we've actually started that intervention reasonably early, and we have, also extended it for more than a month, up till May 3rd. So, this is something I think which is very important in the language that the Honorable PM was using. If you look at it in the long run, there is basically Jaan bhi hai or Jahan bhi hai. It's basically, so that trade-off seems to go away. And I think this is an important aspect that we must do in terms of the overall numbers. So the US in the years, when the mortality was at its highest. By the way, the Spanish flu had 3 waves, with the second wave being the most debilitating. It infected 1/3 of the entire population at that time. The mortality rate then was 10%. Just to give you comparisons for the COVID episode so far, 0.05% of the population has gotten infected. In other words, if we are orders of magnitude away, and hopefully we basically continue to be so. So at this point in time, these may be early days actually, as the epidemiologists are telling us. But at this point in time, compared to the 1/3 of the population that was infected in the Spanish flu, right now is 0.05%. And I think this is a number that we can actually, even while if the pandemic may expand, I think the number may remain stable, which is that unlike in the Spanish flu, where the mortality rate was 10% for every 10 people who were infected, one person, had to suffer death. For the COVID episode, the mortality rate is on average 3.4%. So it is about a third of the mortality rate of the Spanish flu. So the reason I'm actually bringing this up is because, part of it, even, us economists, all of us are also humans, and it's possible that when we make our projections, we may actually be, taken over by saliency bias, and which is basically a jargon for, giving a lot more salience to, to the data that we are seeing in recent times, and therefore saying that maybe things are going to be far worse because, what we are getting right now are really sort of data that is quite, underwhelming and, quite worrying. So I think it's useful to keep in mind this long run evidence, and thereby say that it's possible that the episode, of course, I think, it will be quite damaging in terms of the overall health impact and possibly the economic impact as well. But when you look at it, when we look at it over the long run, things may not be as bad as we are fearing, by extrapolating from this recent evidence. So that's something which I wanted to. Now to come to the specific economic, and many of you would be wondering what basically, what are we doing on the economic packages? Sunita specifically spoke about the fiscal stimulus. I just want to actually clarify a couple of things before we, get to, before I get into the details. So, the USA, for instance, the actual stimulus, fiscal stimulus, I'm not talking about the monetary part here. The fiscal stimulus is 6.7% of GDP. The reason I'm pointing this out is because it's important that we do not mix up apples and oranges. And to give you just an example, for instance, if there are basically loans that are being given and loans are being guaranteed, that is not a direct cost for the fisc. And so those numbers, the loan amounts, actually the principal amounts for those loans cannot be directly added when we estimate the package. For instance, there is this number, and that's what we've done here, and actually estimated the true fiscal package is 6.7%. If you look at the UK number, this is one of the sort of all has been labeled the Rishi Sunak package, and it was covered in the media that he came up with a bazooka of 15% of GDP. What is important to remember there actually is that includes actually not be 350 billion. It will be a fraction of that, and even if we basically use estimates, so the global financial crisis, the overall defaults are 5%. Let's say even if we double that 10% or maybe triple it, even at 15%, actually the cost would be about 50 billion and not 350 billion. So that 15% GDP number that or for instance maybe 20%, for Germany, those numbers are actually, need to be seen, comparisons need to be made apples to apples. So similarly, if you look at for Germany is basically 4.3% of GDP. They actually passed a supplementary budget of 156 billion, and which includes 50 billion, grants to small businesses and self-employed, self-employed individuals. So similarly, Australia, by the way, the number 15.7% is correct. This is a number that actually is these are direct stimulus, which actually adds up to 15.7% of GDP. Overall, the average for advanced economies, the fiscal stimulus is 4% of GDP. Even when you compare across countries, not just the advanced economies, other economies as well, it is 4% of GDP. So this is something that I actually want to keep in perspective. Now, what are the elements of the fiscal stimulus that we must do? I think some of that has already been more is actually being worked on. First is, I think, for households, both in terms of the DBT amounts, and for the healthcare expenditure. The healthcare expenditure, it's actually significant. So that's something which would be important. when you look at in terms of firms, for firms, what is really critical is the credit, ensuring that credit is given, and banks actually give credit where when a tire hits the road. It's not just government saying that this much amount of credit should be given, but banks actually going ahead and doing it, which in times like this, given the risk aversion that is likely to prevail, it would need guarantees, and these could be in terms of first loss guarantees of some proportion, or could be guarantees, of maybe the entire amount. Those are aspects that are being worked on, but those guarantees would be really important to ensure that the banks do feel basically they feel incentivized to go ahead and lend, and that is important. So that's for firms. Similarly, for firms as well, for SMEs, some especially for SMEs, for them to not sort of fire employees, there is a case for them to be worked on as well. And of course, liquidity support. I think the financial sector, do think that is something that all of us as policymakers need to be watching very carefully, because unlike in other countries, we are getting into this episode, with our initial conditions for the financial sector being worse than other countries, and so for us the vulnerability on the financial sector. So that's something that that the government and the Reserve Bank together are watching. Today's announcements by the Reserve Bank on liquidity support, on basically the reverse repo cut, and thereby encouraging lending, some of that should actually have an impact. I think together with some of the steps that I have outlined. But overall, I think, and some of the forbearance measures are also critical to ensure that this is basically what legal language people talk, basically force majeure, to be able to take care of some of those aspects. So that's sort of the broadly what we are looking at. On the lending side, especially working capital loans for SMEs, because on average, and this is something which I gather in the data, that a typical firm rolls over its inventory about 4 to 5 times a year. So and a working capital increase of about 25% should actually enable the firm to be able to tide one quarter well, and that's one of the sort of the broad estimates that we have recommended. So these are some of the broader aspects of the stimulus that I think are important. Let me conclude my opening remarks by saying that we have been talking to various sections of society and all affected stakeholders, taking their feedback, in trying to arrive at this package. A final point that I would mention is that this is also a good time for us to embark on some reforms, and that is also something that we are working on. Thank you very much once again, and I'm happy to take questions.
So let me start off, Subbu, by following up on something that you said, which is that we had a very limited financial capacity even before we went into this crisis. And one of the concerns is that even if you were to lift the lockdown completely today, do we have the financial system capacity to go back to 7-8% growth? The concern being that in the trailing 12 months till January, nearly half of our incremental credit came from external commercial borrowings, and that market is now frozen. So spillover of the dollar would take 6-9 months to come out. So in this environment, what are the options that the government has? I mean, should we test out the PJ Nayak committee that you co-authored? Should we do something to be very creative with the bond market, because it's a great opportunity for shifting the flow of funds to the bond market? Should we take a hammer to whatever is happening in the NBFC market? What are the options that are in front of us?
So that's a very, very good and important question. In fact, I'll break my answer or split my answer into two parts. One is the immediate, what needs to be done, and this sort of splitting I'm doing, given your remark about the NIC committee report, which I would say actually would be something that we should certainly be working on, in the medium term. I would actually worry about, making drastic changes. Because what we want to really do is to drastic changes on the banking side, because right now what is really critical is that the banks basically get over their risk aversion and lend, the liquidity that they have, that they basically should go ahead and lend. And that is where I think that some of these guarantee schemes, credit guarantee schemes actually will take out the risk, because, before we went into this crisis, banks are still sitting on a lot of liquidity. And there was, oftentimes this refrain that there is no demand for credit. And that is why basically credit was not flowing. Now, that particular concern that there is no demand for credit, I think would certainly be not true. At least on the short-term credit, working capital side, yes, firms may not want to borrow long-term, term loans for investment, etc. But for them to be able to actually, take care of their normal operations, I think they would want basically overdraft facilities and working capital loans, etc. So, there would be significant demand for that, and given the liquidity that, that banks have, so I think for me that would be the most important concern, so that, firms basically do not, there is no permanent damage, on the, I think, which is really important. And I also, worry about it from the perspective of supply chain. If even some firms in the entire chain, let's say, suffer permanent damage, that can impact the entire supply chain. So that for me is, I think, the short run. So short run, I wouldn't want to basically break, sort of, give any shock to the banking system. I would basically, say, here's, look, we are taking care of the risk as much as possible. Go ahead, and there would be adequate demand for you to be able to, at least on the short term side. And so that's something which I would basically say on the banking side. This would actually add to, the forbearance measures that the Reserve Bank has basically already announced. And I would also, and this is the other aspect, which is clarifying some of these. For instance, the banks versus NBFCs, the earlier forbearance that was basically being announced, there was some confusion whether it's applicable only to banks, not necessarily for NBFCs. Given that NBFCs do a lot of lending that actually reaches the bottom of the pyramid, I think it's important for them to also actually get the same benefits, because without them getting that, I think the lending at the bottom of the pyramid will not happen. So this is sort of these short run measures that I would, in terms of the, and in the short run itself, I think your question about the bond market, right, and corporate bond market especially, I would say that I think, my sense is that two steps that we've taken before this episode might help us, I think, or quite likely will help us. One is the, enabling the conditions for inclusion in the bond index. That will actually expand the supply, and if we have to do more market borrowing, that supply. So for instance, I was just doing some rough back of the envelope calculations. About $4 trillion of basically money tracks these bond indices. And India is supposed to be having a weight of around 1.5 to 2%, which works out about 60 billion. Now, that much of money we cannot anticipate in this year, given that it's an extraordinary year, and flight to safety concerns, etc. will be there for the investors. Even if we get a fraction of that, it still adds. So on the sovereign, bond side, I think there is actually that supply side expansion, I think, would be very useful. Now on the corporate bond side, and actually you were very right that given the sort of drying up of credit domestically, firms went and did a lot of ECB, which actually is now clearly getting impacted. I think here the one step that may really be useful, but I don't know whether actually it'll show up immediately, is the netting law. Because that sort of would enable some of the hedging of the corporate bond exposures, but it may actually not show up immediately. It may actually take some time for the impact to show up. There may be, SEBI also has come up with guidelines saying that some of the forbearance that basically has been, extended to banks. Actually, those can possibly be extended to mutual funds, etc. as well. Those may help. But beyond that, I think the corporate bond market per se, beyond basically some of the long-term measures of enabling some of the risks to be, sort of hedged through the derivative contract. In the short run, I don't know what will expand the corporate bonds immediately. In the sovereign bonds, yes, but I think in the medium term, corporate bond markets actually should benefit from being able to go ahead with the netting law.
So basically going to the medium term, if I may interrupt, you're absolutely right that there is, whenever we are thinking of a government policy, we have to think about it in two steps. One, while in the middle of a lockdown and perhaps a few months after that, when there is a lot of disruption, you want to do major surgery, you make the system settle down and you do what you want. Even during that period, should we not, there are two ways of supporting bond market, right? I mean, you support the cause of interest. When I see the government of Kerala borrowing at 8.9% and the government of India, which, before the recent crisis was at 6.1, when the repo rate was 5.15, now the repo rate is 4.4 and we borrowed at 6.49% last week. Now, this shows a certain dysfunction in the market. If the government of India is borrowing at 6.49, there is no way that any corporate can borrow at a lower rate. So I think targeting the cost of borrowing is a necessity.
Yeah.
Not just for this reason, but also I think for the sustainability of our own sovereign debt. Because in a normal year, the total issuance by the government of India is 12-13% of outstanding stock. This year, depending on how much we end up with, we could actually be doing 25% of the existing stock, and therefore the coupon that we decide to pay on it is going to be with us for the next several years.
Correct.
Minimizing that has to be an objective. So it serves two purposes. One, it brings down the cost of borrowing in the bond market. It also helps the sovereign maintain its interest cost in the next year. So that's the first thing. Second is that the outflows from the bond markets, from the bond mutual funds, have created a liquidity freeze for quite a while.
Right.
And while the TLTRO and some of the measures taken by the RBI in 27 March were targeted to help that, but they didn't really flow through. There is a reluctance in the RBI in opening the liquidity window for NBFCs and for mutual funds. Perhaps that's to do with the fact that there could be losses and the central bank is not authorized to take those losses. Can there be a fiscal support from the government, a kind of a backstop, so that the central bank then starts doing that? So on both these measures, this can happen. It can be a great opportunity for the bond market to start becoming the intermediary as the banking system is stuck.
So I think that those were very good additions actually. In fact, so as you were speaking, then I thought that I must mention two measures that actually both the Bank of Japan and the Federal Reserve that basically that they use. Actually, one is quantitative easing,
yes.
and second is credit easing itself. Not just to the buying not just government bonds, but also corporate bonds and basically bonds of other investors. I think that is also something that must be on the table, and we actually are. Good that you actually brought that to my attention. These would be ways of actually trying to, one, the QE can help in lowering the steepness of the yield curve, which has become really steep now,
yes.
And because the short end has come down, but the long end basically has. By the way, actually, I'm getting worried that this shouldn't get too technical for the rest of the audience. So, by the way, I think to explain to what we are saying is that because of the cut in the repo rate by the central bank, the short-term rates have come down a lot. But because of the anticipation of greater borrowing by the government, the long run, particularly the 10-year, for instance, 10-year interest rates have hardened a lot. And so this difference between the 10-year and the short run has increased, which is basically what is called the slope of the yield curve. And that's where quantitative easing, which is basically, doing buying some of those longer tenor bonds actually could help in lowering the yields and thereby reducing the slope of the yield curve, which will help because then all other corporates are priced based on the interest rate of that's paid by the sovereign. I think will also help to reduce the spread, what are called the credit spreads as well. And that may also, just the fact that the central bank is actually, or a vehicle set up by the central bank is ready to buy some of these instruments as a buyer of last resort, can actually really enable to get these markets going as well. And that is something which those are. So your point about actually the reluctance, I think, is very well taken. From our side, we will try and pursue it. But let me come back to the question. Nilkant, I think, which is, I think, as I said, and you highlighted that as well, that the next couple of months we don't want to upset the apple cart, but there's a good time also to actually continue working on some of the changes that are required. And I think, so what I have found, and this is a sort of a private audience, and so there has been, to the holding company idea in the NAIC committee, for some reason it's sort of hasn't gotten as much traction, and which relates primarily because one of the key things relates to appointments, basically, appointments on the board and, the CEO, etc. And the holding company idea then comes with basically the part that appointments will then be done by the holding company, which is basically, if you take the Temasek model or other similar models, actually, that governance element of recruitment of directors and senior management is done by the holding company. So, buying on that particular aspect is really important itself to actually go through. So I think that is one aspect that sort of quote unquote the right to be able to appoint people, in these is what is sort of important to be, and then there needs to be debate on that aspect. I think, for the holding company per se idea actually in terms of other aspects of governance is quite acceptable. But this is one aspect which is becoming which has been the stumbling block. And
Okay, so moving back a bit to the federal structure of India. So thinking about state government, for example. So I think today's announcement by the RBI that the ways and means advances limit will be now effectively they have doubled since March. Is I think a very positive step. My own sense is it should have gone up 3-4 times, not just 2 times. But I think they are clearly they are seeing the amount of demand from state governments and they can handle it. But so at some point the WMA amounts. So for the benefit of the audience, the ways and means advances is for a temporary mismatch between receipts and expenditure. It's like an overdraft facility that governments have against the RBI with RBI. But at some point you have to adjust for that. And given that there is effectively 80-90% drop in the revenues that state governments are getting, and I suspect they will not be allowed to breach the 3% of GDP or GSDP fiscal deficit target. What options do we really have in allowing the state governments to spend first on healthcare as the crisis goes on, and secondly on doing what is needed to take care of feeding the migrant workers, supporting local industries like say Goa supporting tourism or Rajasthan supporting tourism and some other industry supporting hotels. So how much flexibility and what kind of options are on the table?
See, first of all, and this is something where I think legal scholars, their opinion actually should be sought. But in a extraordinary situation like we are, in this year, with force majeure basically, in operation, and force majeure actually, works on all contracts. That provision is there in all contracts. And I'm not a legal scholar, but to me it seems like this is the kind of situation where it's completely unanticipated, and all bets are off in some sense because whatever bets were made earlier are all off in this kind of situation. I think this is clearly the kind of situation where force majeure, really comes into play. And so, I would therefore say that the restrictions imposed by the FRBM, Act, I think those could also be basically considered, given this particular kind of, the force majeure clause in contract and regulation, conceptually is but a contract basically between the state and the regulated entities. And so, again, this is something, so I say this based on, my research in law and economics, but, legal scholars will have to come in on that part. So that's, I think, one key aspect that sort of, not putting those, not tying the hands down on spending in a year like this is something that needs to be considered. In and itself, I have actually felt, and that the limits of 3% actually make fiscal policy, far more pro-cyclical than they should be. Ideally, you want fiscal policy to be far more counter-cyclical. And again, this is basically for the benefit of the audience. We just basically say, ideally, when the economy is doing poorly, in other words, actually the actual GDP is lower than the potential GDP. That's when we want fiscal policy to be more intensive, and that's basically that's sort of a counter-cyclical fiscal policy. And pro-cyclical is when the economy is doing very well. But when we say that the fiscal deficit has to be exactly 3% of GDP, precisely at the time when the economy is doing poorly, by saying it has to be only 3%, you actually force the fiscal policy to be pro-cyclical and not allow enough scope for counter-cyclical. So overall, I would actually say that this is something that needs to be definitely considered. On the revenue aspect, I actually feel that yes, Q1 is definitely going to be a wash. But what was quite interesting, for the benefit of all the viewers, is I was looking at the GDP, the output pattern, level, after the 1918 Spanish flu. Even after that flu as well, it was a V pattern, which means that pattern as in, there was a significant decline in output, but when the pickup happened, it came back to basically the linear trend. And as I was saying earlier, it has been historically the worst pandemic so far, with 1/3 of the population getting affected, 10% mortality, etc. So it's possible that and we don't know when will how much time will basically the decline be and the pickup. But if it is supposed, let's say, we are able to move ahead with partial lockdowns, where, for instance, the non-pharmaceutical interventions that I showed in many of the US counties, those did not involve a full lockdown. They basically involved a lot of partial lockdown, social distancing, etc. And that's towards as well. So overall, I think while Q1 revenues may actually be substantially impacted and Q2 also may be impacted, it's possible that the overall impact, actually revenue impact, may be between 1 to 2% of GDP. That's basically the range that I'm looking at. I don't anticipate it to be more than 2%. Worst case scenario, I think 2%. But baseline, I would say, is 1% of GDP, which basically then says 3%, and let's say the same thing for the states as well. So if they're allowed to move from 3 to, let's say, a little bit of scope, you add a 1% because of the revenue, and then add for some scope for the stimulus packages. I think this year that's something that can certainly be considered, so that states can do the necessary spending in being able to to meet the needs now.
So again, moving to
sorry, I'm actually giving long answers. Because I think these details are important. But if you want a shorter answer so that we can answer more questions, let me know.
No. The more detailed you are, the more experience, I think it's better for the audience. So coming to a different topic, which is which had got a lot of perhaps undue attention 2 years back, 1.5 years back, the coordination or interaction between the central bank and the Ministry of Finance. I don't want to sound like a journalist, but I mean there was clearly people. While there is a natural conflict between the two and a very healthy tension and friction that should exist, but perhaps it has become counterproductive. So, in times like these, where the And these are really extraordinary times, right? Because rules are for normal times. These are,
Yes.
it's not a time when, and so a lot of the, what I would call, not really a charade is too strong a word, but a lot of the central bank independence and all of that, I think is something that the developed world, which has kind of developed these concepts, is clearly sidestepping. So now the Bank of England is directly monetizing the deficits of the UK government, and the Fed is now, of course, fired all because it can. What kind of collaboration that you can kind of explore, or whatever you can disclose, and then how good is the collaboration? I mean, that's the question that a lot of the industry folks may have on how are the Finance Ministry and RBI handling the current crisis.
See, one thing, and this is to the first part of your question. Clearly now, it's a far more cordial relationship. I think that there has been a concerted attempt as well. So, for instance, some of us have basically, have desisted from saying anything about monetary policy in the public domain. And to ensure that there is actually a concerted attempt made to have discussions in private and not air differences, in the public. And I think, as you were rightly saying, the healthy debate is always important.
Yes.
Now, conditional on that, I think you're highlighting a very important point, though, that in times like this, between the inflation versus growth trade-off, I think it is really important to actually focus on growth. Also, one more trade-off actually, and that is, earlier when we were talking about the fiscal risk, etc. So we've done some analysis here, and when you look at overall, why do we worry about the fiscal deficit? Eventually, we worry about the fiscal deficit because it affects debt sustainability. The worry is, will we, for instance, will debt start ballooning up, which is that we have to borrow just to be able to repay more and the interest, and so it just keeps going up. In which case, debt is not sustainable, debt is not manageable. But, if for instance, you remain actually within certain constraints, and I'm going to come to that in a minute, that then debt can be manageable. And for debt sustainability, what we've seen is this difference between the nominal interest rate and the growth rate, nominal growth rate, what the economists call the I minus D differential, is really the most important. And the reason I actually say that is, if we've looked at, actually we've done some simulations as well. If you look at in the last 20 odd years, the I minus G differential for India on average has been about minus 4.5%. In other words, the growth rate in nominal terms has been 4.5% higher than the nominal rate of interest. So, in real terms also, because inflation nets out, so growth rate has been 4.5% higher than the nominal rate of interest. Now, why is this important? Because if I actually I as a government, suppose borrow 1 rupee more, the cost for me is basically the nominal rate of interest. The benefit I get is basically the growth rate. So as long as, if I'm actually on average generating a 4.5% greater return than the cost I'm paying for that additional rupee of borrowing, then debt will remain sustainable. And in fact, whenever growth rate is actually higher than even with extra budgetary borrowings, which you can add to the primary deficit. So let's say, and we've done this projection, suppose the primary deficit is 40 basis points of GDP every year, and let's say the extra budgetary borrowing is 1% of GDP. It was 0.9% for instance this year. So let's say the net primary deficit is 1.4%. Even with that, when growth actually hits 5.5–6%, right? 5.5–6% in real terms, then debt is sustainable indeed for India. I think this is a very important point. Actually, a lot of commentators, are looking at this actually in a static manner, looking at fiscal deficit. Fiscal deficit and debt needs to be seen in the dynamic sense. Can we manage the amount of debt that we actually are taking? And that's the other important point is, if you look at the I minus G differential itself, that has been positive only for 2 years in the last 20 years. That happened during the Asian financial crisis. 99 to when it actually went to 3.4%, came down the next year to 1.2%, and then became very negative. So in other words, growth became much higher than. And what basically is, even if we actually have a scenario now, which is like the Asian financial crisis, with basically the I minus G differential becoming positive, but if suppose we replicate the same phenomenon like the Asian crisis, debt will be totally sustainable. Even in the case where we actually have a replication of the Asian financial crisis, but the recovery is not as good, even in that case, actually debt will be sustainable. I think this is very important for us to understand, so that we actually really think about debt and the path of debt actually in all discussions actually about fiscal deficit, which affects inflation, and the fiscal deficit which affects debt, and thereby the Reserve Bank independence versus the government, etc. I think this is really important for us to keep these trade-offs in a dynamic sense in mind. So I would say that therefore, we should basically, this is my considered view, that we should be focusing on growth, because when you get growth, you actually get debt sustainability as well. And in for instance, environment like now, if we go back to and compare it to 2013, when we had the taper conference, whenever we've had episodes like that, we've had because the combination of inflation, fiscal deficit, and current account deficit, all three together were very bad, which is when basically the crisis happened. In fact, we've looked at 2013 or even 1991, for instance. Even 1991 was an external sector imbalance. So 2013, if you see basically, and overall if you plot over the next entire 20 years, it's not fiscal deficit as much, it is inflation and the current account deficit. Those are ones actually that really lead to external sector problems, not fiscal deficit as much. This is really important for us to keep in mind as we basically think about the package for this.
Fantastic. I'm so glad that you're bringing that perspective as the discussions happen in the government. I think I was kind of worried that message was perhaps getting lost as the government focused too much, or perhaps my worry is that systems generally have muscle memories which are formed at times of crisis. So there is a fear of the 91 crisis where we had to pledge our gold. And while it's been 30 years, somehow senior bureaucrats are still worried about the infamy or the shame that was felt, and which was, I think, very genuine. And that could lead to the government being a bit more cautious than it needs to be, given that our external balances are much better than they were in the prior crisis. Now, one very critical part of that is oil, right? So, even though the cartel is very openly, someone has taken to court and ask them, how can you openly cartelize and control prices? But either way, despite all that, the Brent is not crossing 35. Is there any attempt by the government in order to minimize future volatility on the external account? See, there's no subsidy burden now, very minimal, so I don't think there's a fiscal issue there. But from an external balance perspective, is the government thinking about minimizing external sector volatility by locking in these prices?
So I think that's a good point, but I just want to add a couple of more things to what I was saying earlier, which is, so if you look at the three components that I was talking about, fiscal deficit, inflation, and the current account deficit, both inflation and current account deficit for this year actually are not a worry, because oil prices actually, as you said, are expected to be in the 30-odd range, which basically will lower the oil component of inflation. Food prices are basically declined, and given the demand shock that COVID is creating, there is actually there's a deflationary pressure that one can anticipate on the consumption side as well. And so overall inflation is not a worry. Now, and this is a $10 change, I think, in the oil price translates into about $15 billion sort of rough estimate. So that also means that, at these levels, there'll be a 1.5%, positive kick to the current account as well. And this year we ended with basically a current account deficit of 1%, which, by the way, when you compare with 2013, for instance, the current account deficit was like 5%. Inflation was close to 9%. Fiscal deficit was 6.7. When you added the three up, you were looking at about 22, 23. And instead now, when you actually add the current account deficit is only 1%. If you add this 1.5, current account may go into a surplus as well, but I'm not factoring that in, because there may be also financial flows, because of the flight to safety. And so it's possible that, maybe current account stays at 1%. Inflation, let's say, stays at 4%, which is basically, so 4 plus 1, you have 5. Even with a deficit, which, let's say, suppose, just conceptually, I'm not saying we'll go there, but suppose we have a 10-12% combined deficit. Even then, we actually might be at, about 16 or 17, the sum, so which is much lower than the 2013. I think this is the point I want to actually mention, that so all this talk about actually watch out for, I think needs to be, moderated in this dimension. Now to come back to your original question, I think there is a very, very good opportunity for us to actually hedge now that the prices are low. But I'm actually reminded of this history. Dr. Montek Singh Ahluwalia actually tried to do this, when the oil prices actually were very low. And it turns out that if you think from the policymaker's perspective, eventually the person that signs on this, that if suppose basically prices, let's say, go unfavorably on the hedge, then, those who don't understand, will ask all kinds of questions. And there is worry about the usual, the 3 C's, etc. Sound conceptually, practically as well, has unfortunately not moved as much. But I still think it actually makes a lot of sense to be able to actually utilize the opportunity currently. The one point that I would actually mention is that, the market, beyond a certain 6 to 8 months tend to be not very liquid. So, it has to will have to be a synthetic hedge, not really, and that's what, some of the people, who work in this area tell me, that, you can't hedge for a very long time actually, because those contracts are not very liquid. But I think those are technical points.
Wondering if we can move to the audience questions. I see a lot of them there, and you also have a deadline, 6 deadline. So there are questions about lockdown, about how do you want to do this, Dr. Subramanian? Do you want to just go over and pick your questions and answer?
Yeah, why don't you just read out the questions, and I'll try and my apologies to the audience. Actually, I've been giving maybe more detailed answers than required, but my apologies.
So we are told that a lockdown will merely delay the onset of infection. Once lifted, we are told that the rate of increase will shoot up. Example, a city in Japan which has rapid increase in infection once lockdown was lifted. Will this be a long haul with more lockdowns?
So, see, first of all, let me acknowledge I am not an epidemiologist. So whatever I am actually saying is based on a large amount of reading that I've done, in this area. From what I gather, as long as social distancing policies are still implemented, for instance, schools, malls remain closed, I think we will be able to continue keeping this parameter called R0, which I mentioned earlier as well. We can keep that low. Now, my only worry is, and this is about public distribution systems. In some sense, that is sort of the population needs the public distribution system for them to be able to travel to work. But at the same time, ensuring that social distancing is followed there becomes very difficult. I think the main risk I see is that as long as people, are wearing their masks, while being in the public distribution, the public transport system. Sorry, not the public distribution, public transport system. I think we should be fine. I think bottom line, as long as these people can maintain social distancing, What a lockdown does is basically just does extreme social distancing, but even after the lockdown is taken out, you can still continue social distancing, but not at that extreme level.
I'll invite Mr. Mishra to pick the question, just to be fair to everyone. Yeah.
Sure. So there is a question on the private sector banks being better equipped for a quick delivery of credit to SMEs, given the risk aversion and accountability issues. Now, how can this issue be addressed? I mean, you did mention that the government is working on a credit guarantee scheme, but will that be sufficient? Will that, because 60% of the banking system is still PSU, despite the credit guarantee, will you still have PSU banks issuing this credit?
I think that's a good question. So from as we were discussing earlier, when based on Neelkanth's questions, that the last year the credit pickup was about 6 to 7%, and demand side conditions were primarily attributed. There would have been some risk aversion as well, I'm sure. It's possible that if it is all risk aversion, then I would say that the government taking the necessary steps to basically reduce the risk faced by the banks through the credit guarantee should basically take care of possibly the binding constraints, for the public sector banks. So on the supply side, if it were risk aversion. Now on the demand side, as we discussed earlier as well, demand should not be a problem, because now we should have a lot of firms that would be demanding credit. So I think the only constraint there would be primarily, I think, the risk, and the risk coming possibly from the 3 C's, and that may also there have been steps that have been taken on reducing the concerns relating to that as well. So once the risk is is insured by the government through this credit guarantee scheme, I think the PSP should be able to actually lend. And I agree with you, Neelkanth. I see that without the public sector banks actually pitching in, they account for almost 70% actually of the entire. So I don't think private sector banks by themselves, they don't have the reach either to be able to actually cater to the nook and corner of the country.
So basically, there's a follow-up on that this was that credit guarantee in the past has not removed the risk aversion in public sector banks. But anyway, but you're right. I think
So let me respond short. So I think the reference might be to the credit guarantee scheme for the NBFCs. The way the scheme was structured, with basically saying only investors above AA, and you have to deposit some 10% cash, etc. It was really, I think, the constraints made the scheme not quite. So hopefully we basically don't repeat that mistake.
Right. And coming to a slightly longer term question, see, one of the interesting things from that MIT paper that you showed, where the recovery was faster, where the clampdowns were bigger, the non-pharmaceutical intervention. So one of the things is, of course, the move of production away from China. And I believe even before this crisis, which has brought a lot of adverse publicity to China, I'm aware the government was looking at this as a serious opportunity. What are the things that can be done to, and I read somewhere that some state governments already started to sustain business, etc. During this disruption, so of course, post the disruption, I think there will be a complete slew of things we can do. But during the disruption, what are the options that the government has to encourage? And just to see the few ideas, we're already seeing APMC, the agricultural distribution laws, which were effectively a government monopoly, are being forced to get disbanded. Right. So now everyone has a license to sell. Similarly, power distribution companies, given that the power demand is down 25-27%, most of them are the decline in demand is from the high-paying customers, the malls and the movie halls and the industry, and so their losses are spiraling up. So maybe a great opportunity to allow open access or force them to privatize. So what are the things that the government can do during the crisis or to ensure that the Make in India takes a big fillip and we take advantage of this disruption we are causing?
Yeah, I think, you're absolutely right that India oftentimes actually reforms very well in a crisis. And I'll say this in private that I have been using this line within government since July itself, trying to persuade actually more reforms to be pushed through. But I think, even if, let's say, people wouldn't have accepted then, now, we really are facing a crisis. So some of these actually would be, so one option actually is to, for instance, for companies below a certain threshold of employees, could be 500, maybe, or even more ambitious 1,000. Except for laws relating to safety, no other restrictions. Let them basically go, and for instance, no social security, provident fund, etc. So that might create jobs, might enable firms to come in as well. That's one thought that actually that one can see. I think the power sector that you mentioned, because it really affects the cost of production significantly, and I think that's a very important. Similarly, in terms of doubling farmer income, clearly I think the APMC is a binding constraint. And I actually, in fact, I am encouraged because, in some sense, these also give you, nice prototypes to run. So far our approach has been, let's try it in a small geography and say whether it works. We're just using sort of, now we say we can try it for a few months and say, look, it generates so much benefit. So why don't we extend it for and make it the norm? So there are actually, in that sense, this I think really gives an opportunity for pushing through reforms like that. I think on specifically on the Make in India, actually I would given that this was something that we covered in the economic survey, I would push more, and I am doing that on the Assemble in India part, especially focusing on the network products because that has enormous potential to create employment and good employment. So these are all, I think, and even actually another aspect is rationalizing of subsidies. If for instance, we at the kind of deficits that we have, we do really need to look at subsidies. And again, this might be a good opportunity because the political capital possibly required to be able to take some hard, decisions on the subsidies may not be that large, may not have been expended. The political capital expend maybe, not as much. I mean, that's just basically I'm thinking as an outsider, but so these are some thoughts that I think we can certainly push on.
And so, and add on to that, there's a question on the export sector. So, I have seen, and for very right reasons, that SMEs could literally be eating into their working capital, right? So, there are small businesses which have been completely shut, and to feed their families, they're effectively eating into their working capital. So, when you lift the lockdown, they will be stunted. Some SMEs could be shutting down, and clearly, I think the plans that you said the government has, and very eagerly awaiting them. But what about exports? Because I think there are lots of exporters who are also currently struggling for orders. In fact, I was reading, interacting with some logistics companies, that even the port operators, because they're struggling for labor, they are prioritizing imports because they are more essential to export. So exports are stuck, even where there is a demand. So what are the steps the government can take to, or is planning to take to support exporters during this 2-quarter period where demand could be very subdued so that there is no damage, and not just for goods but even for services, right? So the classic tourism and other maybe BPO activities, etc., where if you lose the enterprises now, even when you switch the lights back on, there could be no one to do that.
See, I think this is a far more difficult issue, in my opinion, to actually to tackle. Especially on the services side. In some sense, unlike manufacturing, where activities can continue, without close interactions or with social distancing, service sector activities, whether it's tourism, hospitality, air travel, many of these actually would be far more difficult to have, without being able to, without the physical interaction or with the social distancing policy. So I think global demand for these service activities is likely to remain quite muted, in this year, and so I think I'm to be honest with you, I'm actually at a loss in terms of what can be, apart from just giving them basically loans or credits, just for them to just to sustain them, without such firms being able to do any business. I don't see what is the what sort of kind of, so in some sense, these firms would have to be kept on life support, till basically they are, I can't think about any other, option for basically these kind of service sector exports. On the, again, on the manufacturing exports, I think, what is, and this is something that, we've been working on, which is that, getting the nodal company to set up shop really helps in sort of all the other attendant companies also to come over, and if basically incentives are provided to them together with some of these relaxations that we are, the labor laws, etc., that may attract them to be able to sort of set up that, but though would be actually would be something that will require at least a quarter for it to sort of really move through. So again, I think apart from basically sort of some incentives and credit, export credit, as I said, I think this is a far more difficult problem to solve, and I think post this conversation, ideas on this actually would be really welcome.
Okay, that's a good topic for a good conversation. There is a slightly more, I would say, a question which most people are, I think, consciously avoiding, and that includes me. That the Spanish flu lasted quite a while. Right? I think as we proceed through, so when you were in the first lockdown, everyone was kind of hoping that 15th or 20th April will all restart. 20th, I guess some parts will restart, but it's going to be slow. Again, everyone is hopeful that somehow 4th of May we will see some recovery, and most economic models economists are modeling a normalization after July. What if that does not happen? Because what I'm seeing, and I track this disease, like Mumbai, there are 2,000 cases, right? So if you have 6% critical care need, we're talking about 120, 125 beds that are needed. In the COVID dedicated hospitals, and the fact is that 12% growth, which we are seeing, maybe 15% actually in Mumbai, the growth in cases could be, so we could be seeing a doubling in 6 days. In 18 days, we could see 8x the number of cases if the growth rate doesn't slow down. So, what if we see a triage kind of situation in Mumbai itself? Because clearly the BMC seems to be, as per news reports, already trying to slow down testing so that they only have to deal with the more serious cases. So, what if the disease actually goes out of control? What are the options economically that we have? How does one think about it if you're in the government? One,
I think there are two dimensions to this. One is hotspots, in the interest of the economy itself. As I showed in that particular chart, that where the pandemic is actually more intensive. If suppose we allow those hotspots to actually to sort of grow by removing relaxations, the overall maybe a year period that we have to recognize. So hotspots, and unfortunately some of these hotspots are in areas which actually contribute more to economic activity, compared to the geographical area that they occupy. But I think in the interest of actually the long run impact, actually, I would say we shouldn't be myopic here. I think particularly in times like this, there is oftentimes a tendency to actually just latch on to, what seems to be good in the short run. And I think our policymakers will have to actually be very, very cognizant of the long run impact. And that's where the evidence from the Spanish flu is, I think, very, very pertinent. That's the first dimension, which is that hotspots will have to actually be, in various degrees of lockdown. I think, while others, the not so hotspots, the areas without hotspots actually can be opened up. That's one aspect. And second is actually, even within, let's say, suppose after 20th we're actually allowing activity. We may have to actually restrict it to those activities that do not involve, lot of interpersonal interaction. I think that is something which would be unavoidable. So overall, I would actually say that, in my stance actually, and the advice that I would be giving, the policymakers here is to basically keep focusing on what is right, over the long run, in a year. And that's where actually it's important for us to, it's like when foot forward, you actually feel the stones and then, put your foot. And I think that is going to be very, very critical, in this entire process. So as of now, I think this is what I would say. But it may change, maybe if we are talking a month later, things may have to be different, and maybe positively or negatively, and it's very hard to say.
Right. So coming to, I think quite a few questions on clearing government payables. Now, my understanding is that the FM has been very focused on that, and my own feeling is that a lot of the payables are now with the state government. So, for instance, I think the FM has been at it for several months, and clearly even PSUs have started at least to try to clear that a lot of the payables are from state government, but most people think of government as government. So one is that, but I think to extend that question a bit forward, see, so far the first step, and the government reaction will always be progressive. The first step is to provide liquidity, and provision of liquidity means that you clear payables. How about taking it to the next step? That is on two fronts. The first is you reverse that. You start giving GST credit. That if a firm had paid 10 lakh rupees or 5 lakh rupees of GST last year, you give 30% of that as credit. That you take it, you will settle it later. And at some point, you may even not want to settle it, meaning that instead of just credit, it actually becomes a form of wage support. This also ends up being an incentive for people to formalize, because if there are three firms, two of them had paid GST, the third had not. The two of them are getting credit, but the third is not. So the next time in cycle, you want to be part of that system. Correct. What are the options that you are considering here? Because we seem to be following the Western world with a few weeks lag. So they started with credit support. Now they've already moved to wage support. They've already moved to interest support. Meaning these are just equity kind of investment being made, like written off, right? That will take care of your salary. Where are we on in this process?
So I think these are being seriously considered. On the some liquidity infusions into the companies. On the part of actually, I think there being a lag between what the Western world is doing and we are doing. I think there's a lag in terms of the cases as well. But these are all being considered.
So the clearing of payables, is that still an issue that can be worked on?
That is one of the first things that has been highlighted internally, and actually a real focus has been given at the highest levels. It has actually been it's been followed through.
So there is something on threads. The government departments are not coming forward. That more than 60,000 crores is locked for MSMEs. Is there something specific that the government is working on? This is a question that, is a kind of a follow-up to the payables question. I
thought most of these, would have been cleared. But I think the specific things, that can be brought to our attention, I think we can take a look.
And so, there are sort of big picture changes that are happening, which at this stage are very hard to envisage exactly what will happen. So there is a question on whether Westernness or Easternness, or slightly more society-focused economy rather than a brute capitalist economy. I think those questions will be rediscussed, right? So how much do we pay our doctors? How much do we pay our sanitation workers? Versus how much do we pay people who move around capital? And I'm excluding myself from that. But but I think there is also so that's one type of question. And will there be an attempt to redistribute incomes from the rich to the poor? Is that a probability? And at a global level, the second question is on the global currency market. See, the last two times the US government has gotten into this excessive fiscal spending with monetization. The global currency market has gone through complete turmoil, meaning there's been a break, a structural break. In 1934, as FDR, they were struggling with expanding banking capital. They broke away from the gold standard. Then post the World War, there was some understanding and the Bretton Woods agreement was signed. 71, as they again started to expand money base, money supply, they broke away from Bretton Woods. Now, with the recent estimate for fiscal deficit is 19% of GDP, and the 10-year US bond is at 0.7% yield. Clearly, there is going to be a break in the global currency system. How does Indian policy respond to that? So, two questions. First is the break in terms of economic thinking about inequality, this and that, and secondly on the currency market.
So let me be, I think, on your second question, that's something we actually have to think about, more deeply, in terms of what might be the impact. I am at this point in time, I think, my answer, any answer I could give would be speculative. So I would actually, I don't want to give I've not thought deeply about that issue. It's a very important issue you're bringing to my attention, but I think I would want to think about it. On the first question, I actually have been, and this is possibly the benefit of having, seen basically the Western society and being an Indian. I have actually, to be honest, I've never been that enamored by the hardcore capitalism, the way it actually is practiced in the United States and the Western world itself. And I think many of the viewers may have actually seen that bias possibly reflected in this year's economic survey, the way we basically went up, looked at Arthashastra and the combination of trust and the market, right? The hand of trust and the hand of market. And in fact, this is of course a philosophical point that I actually have believed that, if you take for instance things like, and I'm going to use parallels, take something like turmeric, right? In the 1960s, the Western world called it basically, just a coloring agent, that it has nothing, it has no property. And today you actually go to any Western cafe, they basically sell turmeric latte. And there are basically science articles written on the immunological powers that turmeric has. Similarly, in the 60s, DDT was basically the panacea for all insects, etc. And then they disbanded it, and we basically, we relied on organic. So the reason I'm using these parallels is actually, if you look at even in the Western world now, right, after the global financial crisis especially, the role of people recognize, very clearly, not just in dinner table conversations, but even in public debate, that the financial sector basically failed the benchmark of trust. And that, it's basically overall society itself, and that was a reflection of basically, trust itself getting undermined in society. Related to which, I also actually felt that, I think, again, this is a philosophical point, actually, I do not quite agree with this, in New York Times actually carried this article saying greed is good, which basically says that, and if you want to make a distinction between needs and wants, that, we're pursuing wants actually is what is great for the economy. I think that is something, it sort of reflects, to take an example, what Alan Greenspan thought before the crisis, that markets will self-correct, markets basically never get it wrong. I think, and having studied at the University of Chicago, I have a lot of respect for markets, and I do advocate markets, but at the same time, I do recognize that markets work very well 95% of the time, but they will not work well, whether it's in overtime or across sectors as well. 5% of the time, they may not work very well. And that is why the role of, I think, role of basically philosophical consideration, something that Arthashastra calls, basically it's called, titiksha. So it's, it's something which is very important, to be able to sort of bring these aspects also into play, and thereby, so I would say, the term that I am coming around to in my mind now is dharmic capitalism, which basically sort of has elements of dharma in it as well. And I think India could possibly be, maybe it may happen, during our lifetime, or maybe not. We may actually be possibly the, sort of the implementer of that, given the rich heritage we have of basically, I think, and therefore I feel that all, market participants, producers, consumers alike, also need to go back to, to some of our roots, and just consumption for the sake of it actually, I think needs to also be questioned. So that's broadly what I would actually.
Okay. So I think we have just 2 minutes to go. I think you have to leave. So there is a nice follow-up to what you just said. That dharmic capitalism needs social assets. How do you value them?
So I think that's a very good question. But I think the method of capitalism and having to value assets, those are related but two different problems. But I think what I would take from that question is that dharmic capitalism, or why dharmic capitalism, even capitalism itself requires enormous investments in human capital. Even in the capitalistic model itself, the returns to investment in human capital are very high. So we basically, whether it's healthcare, education, and those are, in fact, when you think about inequality as well, which was what the question was, the perpetrators of inequality are differences in human capital. And those are basically what, takes inequality and carries it over generations. The only way people basically, you get upward mobility across generations is by building human capital. So this part is not departed from the capitalistic model. But what I am actually saying is far more important. Take something like willful defaults, and actually, I don't think in an Indian ethos of basically dharma, I don't think, and I'm making a very strong, this is of course not an economic statement, but a philosophical statement. I don't think, dharma can actually sit together with basically, with willful defaults. And we have actually just abandoned, our ethos, our heritage. So, especially the producers, the richer, people need to actually take this as a cue. And I think now that we are coming to an end, I will end with, I think, with a shloka that I actually really, take a lot of inspiration from. It comes in the chapter 3 of the Bhagavad Gita, shloka 21, which is Yat Yat Acharati Shrestataha Tat Tat Eve Sarojanaha Sayat Pramanam Kurate Lokastad Anuvartate. So, the people who are basically part of the audience, you are the Shresht, and therefore, your behavior, your acharan needs to be like the Shresht, because that's what the Janaha, the population follows, and not just talk, and that's what Sayat Pramanam Kurate, Praman, proof, basically, that's what really matters actually. Sayat Pramanam Kurate Lokastad Anuvartate. So, each one of us that is actually part of this conversation here, has basically been lucky enough to actually be, privileged, and therefore our behavior has to actually be the praman for the, and that's where we should basically be thinking about dharmic capitalism and implementing it.
Thank you, Subbu. This is absolutely awesome. The questioner loves your answer. So anyway, so on that tone, I'll hand it over to Gopal for I guess to thank
you very much, Sunita. Thank you, Neelkanth, for making your time available, and thank you, Subbu, for doing this for us. It's been very, very enlightening, and you also set up in a very clear note, and to which one can only say Paritranaya Sadhuna Vinashaya Duskritam Dharma Samsthapanaya. Thank you so much. Thank you all.
My pleasure.
Let me, on behalf of all the members, again say thank you. I want to request you all to keep this confidential. We should have said that Chatham rules apply, especially when we have a speaker of such great eminence. Thank you, Dr. Subramaniam and Neelakanth Mishra, for a very meaningful introduction. You really reassured us by saying that the COVID penetration is only 0.005% with a fatality rate of 3.3%. We also appreciate your honesty in saying that Q1 and Q2 will be a washout, but look forward to a hockey stick recovery in Q3. Most importantly, we understand the interplay between fiscal deficit, current account deficit, and inflation, and hope that this is an opportunity for you to give more to the citizens and businesses in India. Let me end by going back to the beginning. Prior to the budget of 2020, you quoted from the Arthashastra, and you alluded to three aspects that dealt with the welfare of all Indians, among which preservation is key. So, I'd like to wish you all good evening and thank you. And let us pray for preservation, because I think this is when we need our prayers the most. Thank you.
Thank you very much.
Thanks, Dr. Subramanian. Thanks, Doctor. Thanks, Mr. Mishra. Thank you, everyone.